Last session, we have learned how to describe the risk of stock investment loss. In simple words, we call them the risk of loss. Risk of loss. We have learned to use a term, a concept in statistics called LPSD to measure the risk of loss. Let's have a very quick brief review on LPSD. LPSD stands for lower partial of the standard deviation. And here we use the standard deviation of stock return. In general, the standard deviation, roughly we have two parts when we measure stock returns by standard deviation. The first part we call them the positive return. Positive return. Another part we call them negative return. The word risk is actually a neutral word. For this part of risk, we use the risk with double quotes. I believe investors love this part of risk, right? What investors dislike is the negative return. The negative return. And investors are more sensitive on loss. More sensitive on loss. Here is the negative return. Negative return. Okay. This is the Python script, how we describe negative return. And in the case study, we use this Python command called compare stock. We have used this command in many different purposes, and this is the return. Okay, this is the variable to store the data returned by this Python command, and we can further use the data stored in this variable. In this Python command, the two companies we compare are Facebook and Microsoft. The measurement we use here is the annual return LPSD. Here we have the word annual, indicates we are using a periodic method. Return means we are analyze stock return. And LPSD, we have known the meaning, lower partial standard deviation. Whenever we use standard deviation or volatility or the word risk, you need to be quickly realize that we are analyzing the risk of something. Here we are analyzing the risk of return, And we have LPSD, it indicates we are analyzing the risk of loss, Only when we talk about return, we have the word loss. If we talk about stock price, do we have a direct loss? No, we don't. Okay. Now we can do a quick case study. This time we studied the risk of loss between Tangxun and Xiaomi. Now let's do the exercise together. Please do the exercise together with me. Open your Jupyter notebook and key in the command, and then make some modifications. Okay, if you are not familiar with Jupyter Notebook, look at my screen again. This is the Jupyter Notebook. Now I click here, New Python 3. I'm opening a new Python notebook. First things first, we need to enable the plugin. We have to wait a few seconds for it. I have the command. Now I change the date. To today. And I press Shift key and Enter key together in order to execute the command. And there are lots of messages. The command is prompting us by this message and telling us what the command is doing now. This is the picture comparing the risk of loss between Facebook and Microsoft. The blue solid lines represents Facebook, while the orange dot line represents for Microsoft. From these curves, we can quickly have some points. The first point, from the risk of loss perspective, Facebook is higher than Microsoft. Always higher. Second, although there are differences, but in general, the trend are similar to each other. Roughly similar, but not exactly similar. Roughly similar. The reason is they all belongs to IT company as well as internet company. While Facebook is more close to an internet company, while Microsoft is still a traditional IT company. That's why there were some differences in the trend as well. As for their spread, we have here, they have the smallest spread, but for most of the time, the spread, they changes, but not much. One thing very significant, starting from, this is roughly January, February, March, April, I believe here is February. Starting from February, the risk of loss for Facebook rises significantly, sharply. If you are a security analyst, you have to clearly warn your customers, your investors, to be very careful about Facebook. Be careful. However, just by the rising risk of loss, it's not enough. It's not enough. We still have to analyze the other trends, such as return, such as price, stock price. And we need to combine all these trends together. Then we can have our advices. This is the case study between Facebook and Microsoft in terms of risk of loss. Then we can do another one. Another one is Sinopec versus CNOOC. So Sinopec and CNOOC, they are both stocks listed in Hong Kong Stock Exchange. And we can see the suffix .hk. And we can change here. We can change here using CNOOC. And we execute. I believe their trends are similar to each other because they all belong to oil companies. They are all SOEs. This is pretty interesting. The actual situation is not very, not as my expectations. Actually, their trend on risk of loss is not that similar to each other. Let's look at this one. These are dates in the last 2 years, starting from 2020, then 2021, 2022. It's actually 2.5 years. 2.5 years. And the blue solid lines for Sinopec. And this is for CNOOC. Again, CNOOC represents China National Ocean, probably, oil company. Here, Sino means China. Pec means petroleum. Sorry, it's petroleum. Their risk of loss not similar to each other. This is interesting. Actually, these two companies have much similar things to each other. First, they are all oil companies. Their businesses are quite similar to each other, such as oil mining, oil refinery, and oil sales. Second, they all belong to SOE, as they are all SOE companies, state-owned enterprises. Third, they all listed in the same stock market, Hong Kong Stock Exchange. Hong Kong Stock Exchange. Yeah, but the trend in terms of risk of loss are so different. That's pretty interesting. Okay, we also see some of the similar trends starting from here. So this is probably March, February or March. They all goes up, down, and down. That's right. But the trend is, we are difficult to say. They are very much similar to each other. And then goes up. They have their own respective characteristics. To be very friendly, I feel it difficult to explain why their trends look like this. If you have a good idea, you can share with us. In Module 1, we talk about stock. Our module homework is we choose 2 stocks. Any stock you are interested. You can choose the stocks from mainland China, from China, Hong Kong, from Japan, from Korea, from USA, even from India, from France, from Germany, whatever. The security markets in these countries and regions are all supported in CF. After we have the 2 stocks, you can describe their recent price movement, either in the lines or K lines, and compare their trends. Please provide your comments on them. And then describe the recent movement of the stocks and using periodic returns and holding returns to analyze their trends of returns. After that, you can analyze the risk of their price movement, the risk of their returns, as well as the risk of their loss. You can apply the skills you have learned in this module together. This is the end of Module 1. If we have any questions, we can post our questions in our course WeChat group. I like this picture pretty much. It's a road ahead. And it's our objective. And the road, we can see the road, but the road is not flat. It's not that flat. So this is pretty much similar to our future career path, Okay, if you have no questions, let's move to Module 2. Module 2. In Module 2, our big topic is bond. Module 1, our topic is stock. Stock and bond are the 2 most important products in security investments. The 2 product lines in security investment, stock and bond. In this module, we will have a brief introduction to bond, and then we will introduce the bond markets in China. And we will analyze the bonds price movement. Then we will learn lots of things related to bonds. Say, for example, in bond investment, the most critical factors to influence bond pricing is interest rate. In this way, we will spend quite some time to study interest rate. In interest rate, we have an interesting relationship called term structure. Term structure, if we explain the term in simple words, is a kind of relationship between short-term interest rate and long-term interest rate. Another very important and interesting related to interest rate is called inflation. And inflation will influence the currency value. Another word for currency value is called currency purchasing power. Currency, purchasing power. Those are very important topics related to bonds. And at last, in this module, we will learn the pricing models. Pricing models for bond. These models were initially proposed by a guy called Yueyang. So these pricing models are also called Yueyang's law on bond pricing. Yueyang's law on bond pricing. This is a little bit complicated, but very useful for understanding the changes of bond price and the key successful factors in bond investment. Now let's look at the first couple of topics in Module 2, bond. First, we'll talk about what a bond is. Then we'll focus on understanding the elements of a bond. After that, we will talk about the types of bond. And in this topic, we will talk about some of the special type of bonds. We call them varieties. They are not similar to normal bonds. They look weird. So in this way, we call them varieties of bonds. And topic 5, we will talk about credit rating of bonds. This is a real bond. This is a real bond issued by Canadian government. So it is a Canada Treasury bonds. It's a Canada Treasury bond. And it carries interest. So it is also called a premium bond. A premium bond. If there is no interest rate on a bond's coupon, we call them discount bonds. Discount bonds. This is a premium bond. Right? This is a premium bond. That means it has an interest rate. And the interest rate is, let me find out. How much is the interest rate? It says the interest in this bond is a compound interest. A compound interest. Not a simple interest. Compound interest. The opposite side of a compound interest is called a simple interest. I haven't found out the interest rate here. Probably here. This shelled. This part is French. This part is English. And the issuing date is 2005, March the 1st. And the maturity date is 2015, March the 1st. I haven't found out the interest rate here. Okay, this is a real bond. This is a real bond. The question here is, what exactly is a bond? We can have a brief definition on bond. And in definition of bond, we have a few keywords. So first keyword is, it's a fixed income instrument. The fixed income. The word fixed income means your return from investment of a bond is fixed. Return from a bond investment is fixed. This means the risk of investment bond is relatively low or less risky. Less risky. This is very different from stock investment. Stock investment, we have known that they are highly risky, right? They are highly risky compared to bond, but their return might be very high as well. Of course, might be a loss as well. So this is very different from stock. A bond represents a loan, the second keyword. A loan. A loan from who to whom? Made by an investor to a borrower. And the borrower here is the company or government that issued the bonds. So we have a loan. A loan. For every loan, we have two parties, right? So here is party A. Here is party B. A loan. This is a loan. And we have investor here. Investor. And party B, we have companies. We have governments. So This is a relationship of loan between party A and party B. Okay. This is a loan. And for companies, the bond of loan for companies, we call them company bond. Company bond. And in China, we actually have two kinds of company bond. One is called enterprise bond. Enterprise bond. This is primarily for SOE companies. Another is called corporate bonds. Corporate bonds. This is primarily for commercial companies. Commercial companies. Or non-SOE companies. Of course, SOE can also issue corporate bonds. And for government bonds, we also have many types. For the bond issued by the central government of a country is called treasury bonds. Treasury bonds. And for the bonds issued by local governments, we call them municipality bonds. Municipality bonds. Inside the treasury bonds, we also have short-term bonds, mid-term bonds, and long-term bonds as well. Short-term bonds usually within 1 year. Mid-term bonds usually less than 10 years. And long-term bonds usually more than 10 years, 10 to 30 years. In history, we haven't seen long-term bonds for about 100 years. 100 years. The purpose of a bond. Why company or government issue bonds? They want to finance projects and operations. Here, finance is a verb. It's a verb. Means raise money for something. Finance projects and operations means they expect to raise money from the public for projects and operations, governmental operations or business operations of companies. For example, 30 years ago, the central government of China decided to build the famous Sanxia Dam, Sanxia Daba, and needs at least 200 billion RMB. 200 billion RMB. The central government used bonds to raise money to support the project. They use bonds. The bonds is called Sanxia bonds. Okay? That means the central government borrow money from the people in China. Now we have understand that bonds is actually a loan from investors to bond issuers. And the loan from the perspective of issuers is actually debts. But what are the differences between bonds and debts? Whenever we talk about debts, we know that it's the critical factor in a spreadsheet called balance sheet. For a company or a government, in balance sheet, we have, generally speaking, three big parts. The first part is called assets. And the second part is called liabilities or debts. And the third part is called owner's equity. Right? And debts is this part. Usually, a company's debts, traditionally, they borrow money from banks. Or trusting companies. In this way, their creditors are a few financial institutions. These are banks and trusting companies and other lending companies, institutions. Each creditor lend them huge amount of money, for example, in the units of million, even billion RMBs. However, bonds are very different. Bonds is an innovative financial products. Compared to traditional loan. Why? Here we have traditional loan. its amount, probably millions, even billions. For some of the company, for example, for Hengda, the loan may be trillions. For Hengda. And bonds are very different. The first difference between bond and loan is the dollar amounts of bonds usually very small, such as 100 RMB or 1000 RMB per bond. Second, the lenders or bond investors, there are millions of investors, millions of bond investors. While for loan, there are just a few financial institutions. A few. And third point, for loan, usually their creditors are financial institutions. While for bond, their creditor could be institutions as well as public individual investors. Individual investors. Okay. Fourth point, loan, usually the creditors are not to the public. Not to the public. In this sense, we can say them, they are private. While for bonds, most of the bonds, their investors are public investors. Public investors. We know that for government administration, anything that is related to public, if anything is related to public, government will try to manage that because public things matters. Public things matter. Here matter is a verb. Okay. This is the meaning of unit of debt. Unit of debt means bonds is an innovative financial product. The innovative point is it split usually a huge dollar amounts of debt into many smaller pieces. Many smaller pieces. So that individual investors could participate in. In this way, we call them securitized as tradable assets. What is securitized? Debts. The debts part in a company or a government's balance sheet is securitized as tradable assets. Assets of what? Investors. Assets of investors. And recent years, we have a very popular word called assets. Securitization. Asset securitization. We find that bond is one of the major measures. Bond is one of the major measures. Of course, we have other products related to asset securitization. Okay, here we are a little bit difficult for you to understand. Well, another point is a bond is traditionally paid a fixed interest rate. It's called a coupon. It's called a coupon. However, in recent years, they have some new innovations on bond. We also have variable or floating interest rate bonds. Now become quite common as well. But traditional fixed interest rate bond is still the mainstream. It's still the mainstream in market. Still the mainstream. Next time when you see a bond with variable or floating interest rate, don't feel too surprised. The relationship in a bond between bond issuer and investor. This figure briefly describes the relationship between issuer and investor. First, let's look at the issuer. The issuer, we call them debitor. Usually it's a government, institutions, companies. Can we individually issue a bond? No. Okay. Issuer and bond issuer issue bonds. Issue bonds. Then we look at bonds from the perspective of investor. Investors are also called creditor in bond. In stock market, can we call investor creditor? No, because stock is not a kind of relationship of loan. So This is another difference between stock and bonds. The investor could be government as well, could be companies, could be institutions, but could be individual investors. So this is pretty important in bond market. An investor purchase bonds. This process we also call bond investment. Bond investment. And then at specific date, we call them coupon date. Coupon date. Bond issuer need to pay interest to investors. Another kind of date is called maturity date. Maturity date. On maturity date, bond issuer should repay the principal back to investors. The principal. We also call them the face value of a bond. Face value of a bond. Or par value of a bond. Par value of a bond. Although bond is less risky, there are still some risks related to bonds. And the risk of bonds comes from the source of return of a bond. This is very interesting. Risk of a bond. Risk of a bond comes from its return. In this way, we see the risk and return are closely tied together. Closely tied together. Okay. Now let's look at from the return of a bond. So this is the return of a bond. And we have two sources of returns. One is called interest, another is called capital gain. Now let's have a 10 minutes break. And after the break, we'll continue.